Welcome to the Nexus Point, a podcast for next-gen accounting firms. Here's your host, Jeff Bruskin.
All right, welcome back to the Nexus Point Podcast. My name is Rich, and as always, we are joined by the managing partner and CEO of White Tiger Connections, Jeff Bruskin. How you doing today?
I'm doing great, Rich. How about you?
I'm doing all right. You know, the holiday season is winding down, but also winding up at the same time. So it's a lot of craziness, but, you know, that's the world that we live in right now. So that's always good. Today, we're going to be jumping back into a topic that is very prevalent in the market today. It seems like the CPA profession is white hot with not only private equity, but wealth management firms jumping in. So today, we're going to dive into that wild little triangle between all of those interconnected spaces, and we're just going to have some conversation, asking questions, and talk about what not only you're seeing, but just your expertise on, you know, the market and why CPA firms might not want to talk to the private equity or structures that we've maybe seen that work out well. So first question I just want to jump into today is, why are wealth management firms so interested in acquiring CPA firms right now, or just the space in general?
So for a long time, wealth management firms, financial advisors, financial planners have had an interest in connecting with CPAs. Historically, it was because they needed a CPA, especially tax advisor or tax compliance person, to be able to help execute whatever the strategies and the tactics that the wealth management firm had for their clients' tax needs. You can't buy insurance or annuities, or you need someone, if you're managing, quarterbacking the client relationship, to be dealing with their brokerage statements and their K-1s from at least the filing standpoint, if not from kind of a tax strategy, tax architecture standpoint. A lot of wealth management firms, Rich, as you know, they do tax planning, but they don't do tax advisory. The distinction being tax advisory is advising on a tax situation and kind of a tax architecture strategy beyond even the particular vehicles that a wealth management firm is able to deploy as part of their wealth management financial planning capability suite. So for example, 1031 exchange, real estate transaction, this is something that wealth management firms, unless they deal with real estate brokerage, aren't going to touch typically, but they might have clients who have real estate needs, and the client expectation is commonly that the wealth management firm is going to comprehensively handle their clients' needs. And so tax advisory, tax compliance, at least to have the clients of the wealth management firm appropriately taken care of. That's been the historical reason why RIAs and broker dealers want to have great CPA firm partnerships. And of course, also because of the referral stream. The CPA firm is dealing with clients that have investment needs, that have planning needs, that have insurance needs. And so that's been the historical context for it. Maybe I'll anticipate your next question. The reason why things are reaching a fever pitch right now is because more and more client expectations at the wealth management firm is that the client, especially the high net worth, the closely held business client, are going to receive all of their kind of planning, tax, accounting, bill pay, family office needs, ideally in one place. That's the Creative, the Mariner model. And, these firms kind of have, if Fidelity, Schwab set a precedent where it's available in the market. You can come somewhere and get everything that you need. Of course, the reality of delivering that is a lot different, but from a branding perspective, it is where everything is going.
You couldn't have taken the words any better out of my mouth. I will say that. It's like you have a fortune teller ball of what I was about to ask. But that is very helpful.
Folks who have these questions, so you know that.
I can tell. And yes, I have that. I've been on those calls as well. And, I just hear constantly too, the ones that really, I feel like, come to the table ready to play. It comes from that space where they're really trying to solve for the client first, as opposed to, what the value adds may be. I get a real good sense of like, they're really trying to solve this for their clients because their clients mean so much to them, as opposed to just what the revenue stream. That kind of is the secondary, but it very much is an important part. But once they feel like they solve for their clients, not only are they happy, then they see the fruits of their labor post once they figure all this stuff out. But on the flip side of that, when it comes to the young CPA firm owners who have really strong practices or just in the space in general, why might the conversations with private equity, be more eyebrow raising as opposed to,
Sure.
like very, energetic and things like that? Why might it be a little bit like, I'm not too sure about this. If you can just touch on that for me a little bit.
So private equity, as pertains to CPA firms and RIAs, broker dealers for that matter, both spaces are absolutely gangbuster with private equity activity right now. PE's thesis is 95% of the time retrading oriented. And so even if equity is going to be rolled into the private equity structure, you're taking chips off the table, if not kind of having a complete exit. And, part of that complete exit might be working towards that second bite of the apple, but how meaningful is that actually? How reliable is that in the context of the risk associated with, does this PE firm have a proven model? Do they have a corporate recruiting thesis? Is the culture, which is a gigantic tangible, intangible, is it going to be such that it's in alignment with our values and also in alignment with what is needed to scale? These are huge, huge unknowns, oftentimes where the risks outweigh the rewards. And therefore, there's a lot of froth in private equity's attentiveness to CPA firms, actually even more so than wealth management right now. And where I think that young CPA firm owners, to speak to your question specifically, Rich, have maybe a different sort of type of outcome in conversation of mergers with independent wealth management firms, meaning non-PE backed wealth management firms, is how does the pro forma of their cash compensation as well as their enterprise value growth, how does it become significantly more meaningful than if the CPA firm owner was to remain independent and independently scale? And the answer is it can become significantly more meaningful because the wealth management firm can kind of incentivize and compensate that CPA firm owner who's young and has trajectory in front of them and an appetite for building infrastructure, with not only the accretive growth of now a faster growing CPA firm, because all of these wealth management clients are in such tremendous need of tax services, bill pay, accounting, the kind of nuclear services that Rich, a CPA firm, provides, but also because that young CPA firm owner can now participate in the accretive growth of the wealth management business, which is only happening as a result of the tax and the accounting business, which is coming in. And then there is additional growth in that wealth management firm that's only happening because tax, especially, Rich, is as you know, a function that the market is incredibly high demand for. So a wealth management firm knows not only do their existing clients need the services, but a CPA firm is not bound by the marketing restrictions that a wealth management firm is bound by to be adherent to SEC and FINRA compliance. But it is also just a higher demand service because there's a supply vacuum of competent CPA firms who can provide tax and accounting services. So a high net worth client comes in to the CPA firm because they need tax. They're now a passive lead for the wealth management firm to be able to nurture in the years ahead. And that's something, all of that is to say the young CPA firm can take advantage of those things, the young owner. And is there risk? Absolutely. Is it significant? Yes. Is it less than what the private equity model is providing? Arguably so, because this model, what we've seen as a firm, Rich, as you know, is that the independent wealth management firm that has not yet proven concept, okay, this is the instrumental piece on the CPA firm thesis, is where all of this latent value exists. So for the young CPA firm owner, maybe being the 6th or the 12th or the 20th or even the first acquisition by a private equity firm is more risk than you want to stomach at this point, not enough reward. But being a merger with an independent wealth management firm can be less risk because it's more culturally controlled. It's less parties to have to make sure they align with what your vision is for your firm. And you get the benefit of kind of this second, third bite of the apple, sort of massively scaling business model where you do not need to kind of go at it alone and just be localized to these less cash flow rich, less enterprise value rich services that are tax and accounting and payroll. Far more cash flow rich and more enterprise value rich are the wealth management firm model. And so if you can participate in both and have some of that risk assuaged, this is something we're seeing a lot of youth in the CPA profession that are entrepreneurial evaluating right now.
Well, that was a lot of really great information. I appreciate you touching on that because early on in that answer, you kind of touched on what I think the CPAs who are actively in conversations with private equity are missing some of on that risk and that unknown. They're kind of overlooked because there's so much money being thrown at them. It's very easy to overlook, those cultural or back end commitments that they, need to,
Right.
that are like the foundation of their practice originally. And then later on, if we can, I hope that we can maybe touch on like a structure that you've maybe seen or you've maybe advised on like
Sure.
what that partnership model really looks like. Because I think, how you're explaining it sounds like it's very easy to understand. It's very easy to follow. And I think like it is naturally, if you can, like I said, just share a little bit of how that structure, what that structure looks like. And so that way the CPA firm owner and the RIAs can still, gain the support, have the support, solve for what they're trying to solve for, but then also have that capital to continue to grow.
So one thing I'd like to say is that joint ventures they sound really good on, in concept, but on paper, they don't often work that well. And that's something that I think a lot of wealth management firms will relate to. If a wealth management firm could get around having to own or be invested into a CPA firm, but still have the service that their clients need, still have kind of the untethered marketing capability, and still have the ability to source clients because they're currently tax or accounting and there's a service provider referral structure. Yeah, the joint venture would be pretty attractive, but there's a lot of smoke and no fires is what we hear again and again from RIAs and broker dealers that try to do that. And so from the wealth management firm's perspective, the question, and actually from the CPA firm's perspective as well, Rich, the question is commonly, and we see this time and again, how do we mitigate risk, but how do we kind of take a step that is going to create this unified structure that everybody talks about, but is very difficult to execute in reality? There are compliance restrictions, there are operational restrictions, there are scalability restrictions, especially when you talk about a tax business, which can be very seasonal with compliance. There are staffing restrictions on the CPA firm side. And then you've got to figure out the financial pieces, a lot of moving pieces. So what we see typically, to answer your question directly, is you want to take a cadenced approach. You want to have kind of a step 1, step 2, step 3 sort of structure where you are incrementally building trust, you're proving concept, you're building an operating structure, which is going to give the client, to your point about all of that value, that you need to be client first, because if the client isn't at the center of the thesis you're building, then you've lost something. The question isn't how to monetize this most effectively, it's how to give the client as much of what they need as possible. And the monetization will obviously follow that. So if you take these incremental steps, you can build the trust, you can prove concept, and go into more detail if that's helpful. But ultimately, there's not a one size fits all model. Whatever that cadenced approach is going to be a combination of what kind of the most burning need is on the wealth management firm side, and what kind of the strongest capability suite that the CPA has. And capacity is always a question. So do we have to scale something up? Do we have to hire people? Do we have to implement more technology? Do we have to invest into doing this? Or is this something that we can take advantage of existing systems that we have in place? All of this is flushed out on what resources each party is bringing to the table, and then what the right cadenced approach is to solidifying a marriage that's going to work out in the end for the client best of all.
Understood completely. And the last thing I just want to touch on, I know we've been talking about how, wealth management can try to, go out to the market, try to find CPA firms, same thing that private equity is doing. Is this possible to do because everybody is fighting over the same quality of firms that are going to actually be able to do this? And there's so very little of them. Are wealth management firms capable of doing this without, buying first? Are they able to solve for this, kind of maybe not retroactively, but are there ways around just going out and fighting for the same amount of firms that everybody else is fighting for?
Yes, it's a great question, because everybody talks about the retirement boom, Rich, that's happening right now in the CPA profession, the talent vacuum, and it's real. But what the problem is that the CPA firms that are on the market, or off the market for that matter, the reason why they are evaluating a sale is 96% of the time because they lack internal capacity to begin with. So if you want to buy an accounting firm, if you're a wealth management firm and you want to penetrate into the suite of CPA capabilities for your clients and all of the other benefits we've been over that it provides for you, and you want to do that through M&A, if you're buying a CPA firm, Now it's in the 96%. Not only do you have to solve for the capacity problem that they're facing, but you then have to fix the operations, the technology, the workflow, because these firms are very antiquated, do all of that while then being able to support your clients with the CPA services that they need. So it is not as simple as a plug and play. And I think a lot of RIAs and broker dealers, Rich, that have been in the market now for more than a couple of quarters and kind of have been having conversations with folks are really realizing this. And so it doesn't mean that M&A is not an option for you. There are anomalous firms that have capacity and infrastructure and serve clients at the caliber that your clients are, whether it's, retail, mass affluent, high net worth, ultra high net worth individuals. So it doesn't mean that M&A is unavailable to you. It just means that you should also, to your point, Rich, consider an organic approach. So what is organic? It means hiring the talent to get the CPA firm off the ground. Now, you can hire the talent if you're an RIA into your existing business because you do not have the compliance restrictions. Some states are quirky, but typically RIAs do not have to separate church and state when it comes to, and by the way, some back offices are quirky, but most of them, from our experience, do not have to separate and say, hey, we can't do tax planning as a firm because we're a wealth management institution, while broker dealers will always say that there has to be that separation of church and state. But even broker dealers can stand up a third-party entity in most cases and hire talent into that entity. Now, both for the RIAs and the broker dealers, you have to we understand that you know nothing about running a CPA business whatsoever. So we will help you. We will consult with you on the operational paradigms associated with running a CPA firm. And we provide fractional CEO, fractional COO services. There's a lot of nuts and bolts that make running an accounting firm, I believe, objectively harder than running a wealth management firm. But these things, when you've got the right workflows, the right software, the right talent in place, fully remote talent is very, very big. It becomes surmountable. And so you can build out a comprehensive platform of services without M&A. You don't need the inorganic. You can do it organically. And for a lot of our clients, we actually suggest that that is the right way of entering into the market. Once you have a solution built, once you have the right technology, at least one person hired who's doing tax compliance as an example, and there's the beginning of that integration with your wealth management and planning functions, you now are, believe it or not, more attractive to the owners who are retiring, who lack capacity, because you can say to them, look, we have this operating structure, which is working successfully today, and we can just take you on and integrate you into our model. And a lot of firm owners, Rich, are looking for that kind of certainty that you understand in the wealth management world, how to integrate their business.
Mm-hmm. Sounds like it's a lot about proof of concept too. And once you have if you come to the table with a strong thesis, it already sets you apart from, in these conversations, from the people who are just like, we're trying to figure it out, but we have no real backing. So I appreciate all of your insight as always, Jeff. You're always so insightful. I know you're the high level of expertise you have on all of this stuff, and it's always great having conversations with you weekly. So with that, we're going to sign off for today. And as always, we hope that you guys enjoyed the episode, and we'll be back with another one next week. Thanks. Bye.
Thanks for listening to The Nexus Point, a podcast for next-gen accounting firms. If you enjoyed this episode, don't forget to subscribe and share this podcast with your friends. See you on the next one.